Modern financial systems do not collapse the way they once did. They are absorbed. When large institutions approach failure, governments intervene, not to protect individual firms, but to preserve continuity. Since 2008, markets have operated with an implicit understanding: systemic collapse will not be allowed. This expectation has reshaped risk-taking, pricing, and behavior across global finance. Losses may occur, but disorderly failure has become increasingly rare. Central banks expand liquidity. Governments guarantee deposits. Emergency mergers are arranged within days. These actions stabilize markets. They also change incentives. When participants assume that catastrophic outcomes will be prevented, risk perception shifts. This is the story of government backstops, moral hazard, and how preventing collapse may quietly transform the system itself. Government backstops refer to mechanisms through which public authorities intervene to stabilize financial systems during stress. These include central bank liquidity facilities, deposit guarantees, asset purchase programs, and emergency resolutions. Historically, banks were allowed to fail with limited intervention. The global financial crisis altered that framework. The collapse of major institutions revealed how interconnected markets had become. Disorderly failure produced cascading effects beyond individual firms. In response, policymakers expanded their toolkit. Capital requirements increased. Resolution frameworks were developed. Central banks signaled willingness to act decisively to preserve financial stability. Since then, interventions have occurred during episodes of stress, from funding market disruptions to rapid bank failures. Authorities often emphasize that support is aimed at the system, not shareholders or executives. The presence of backstops has become embedded in market expectations. Investors, lenders, and institutions operate within an environment where extreme collapse is viewed as improbable, not impossible. Government backstops were presented as safeguards against systemic panic. The promise was stability. By providing liquidity during stress, authorities could prevent temporary shocks from becoming structural breakdowns. Deposit guarantees reassured households and businesses. Emergency lending facilities stabilized funding markets. Asset purchase programs supported price discovery when private buyers withdrew. The broader promise extended beyond crisis response. Stronger regulation and oversight were intended to reduce the likelihood of future bailouts. Backstops were framed as tools of last resort, not permanent guarantees. Markets interpreted these signals as credible. After 2008, volatility often triggered swift policy responses. This reinforced confidence that severe dislocation would be managed. The promise was not the elimination of failure, but containment. Institutions could still incur losses. Shareholders could still be wiped out. What would be avoided, policymakers suggested, was systemic collapse. This distinction shaped behavior. If collapse is unlikely, risk may appear more manageable. The expansion of government backstops coincided with growing central bank influence. Balance sheets expanded. Interest rates remained low for extended periods. Liquidity became abundant. During periods of stress, authorities acted quickly. Funding facilities were reopened. Emergency mergers were facilitated. Deposit guarantees were extended beyond formal limits in exceptional cases. These actions were effective in restoring short-term stability. Markets calmed. Credit flows resumed. Institutions survived. Over time, the presence of intervention capacity became part of financial architecture. Risk models incorporated assumptions about policy response. Investors monitored central bank communication as closely as corporate earnings. The power of backstops lies not only in action, but in expectation. When participants believe that systemic collapse will be prevented, they price assets differently. Credit spreads compress. Leverage becomes easier to sustain. This dynamic does not eliminate risk. It redistributes it across time. Stability today may increase fragility tomorrow if behavior adjusts to perceived protection. The rise of backstops transformed governments from reactive actors into structural participants in market stability. Government backstops reduce immediate panic, but they can alter incentives in subtle ways. When institutions believe that liquidity will be provided during stress, short-term funding becomes more attractive. When investors expect deposit guarantees to expand, they monitor risk less aggressively. This dynamic is known as moral hazard. Protection changes behavior. If extreme losses are absorbed by the system, participants may accept higher risk under the assumption that consequences will be limited. The distortion does not require explicit guarantees. Implicit expectations are sufficient. If markets observe repeated interventions, confidence in future support strengthens. Backstops also create political constraints. Authorities must balance financial stability against concerns about fairness and taxpayer exposure. Interventions can protect systemic continuity while eroding public trust. The system fails when expectations of support become embedded too deeply. If risk-taking expands faster than regulatory oversight, backstops may need to grow in scale to remain credible. Paradoxically, the very tools designed to prevent collapse can encourage structural dependence. Markets adjust to stability as if it were permanent. When authorities hesitate or face limits, uncertainty increases abruptly. Government backstops are most effective when rarely used. Frequent reliance signals underlying fragility. Stability achieved through intervention can mask vulnerabilities that accumulate over time. The failure is not of policy intention, but of behavioral response. A true collapse would occur if a backstop failed to convince markets. If participants doubt the willingness or capacity of authorities to intervene, confidence could evaporate rapidly. Such a moment would not be triggered by a single institution, but by credibility itself. If inflation constrains central banks or political resistance limits guarantees, the assumption of rescue may weaken. In that environment, risk premia could reprice quickly. Funding markets could tighten. Institutions dependent on cheap liquidity would face immediate strain. The collapse, if it arrives, would not represent policy absence. It would reflect policy limitation. For now, backstops remain credible. But credibility depends on perception, and perception can change. The aftermath of reliance on government backstops is subtle. Financial systems appear stable. Crises are shorter. Panic is contained. Yet leverage cycles continue. Risk migrates into new channels. Public authorities remain central to market functioning. The line between private markets and public support becomes less distinct. Stability increasingly depends on coordinated intervention. Government backstops preserve continuity. They also redefine it. Modern finance operates with an implicit guarantee. Collapse will be managed. This expectation stabilizes markets, but it also reshapes behavior. Backstops are not inherently destabilizing. They are necessary in interconnected systems. The question is how frequently they must be used. If stability requires constant intervention, fragility may be deeper than acknowledged. The story of modern finance is not simply about risk or innovation. It is about the relationship between private incentives and public responsibility. Government backstops ensure survival. Whether they ensure resilience remains uncertain.